Today, we're breaking down the new India-U.S. Trade Pact, a focused agreement that tweaks how these two economic giants trade select goods. The main aim? Lower tariffs on certain products, making trade smoother and more profitable for both sides. Unlike sweeping free trade deals, this pact targets specific sectors, especially agriculture, where India is cautious to protect millions of farmers. For India, the challenge was to open up just enough to benefit from U.S. markets, without risking its own agricultural backbone. The U.S. wanted to sell more farm goods like animal feed and apples, while India sought better access for its tea, coffee, and rice. The result? A compromise. Some American products get easier entry into India, and select Indian goods find a clearer path to U.S. shelves. But these changes come with conditions, like quotas and minimum prices, to shield vulnerable sectors. This pact is about give and take, aiming to boost economic ties while minimizing disruption. For consumers, it could mean more choices and better prices. For businesses, it's a chance to tap new markets. For farmers, the impact will depend on what they grow and where they sell. The details matter: who benefits, who faces new competition, and how the rules are enforced will shape the real outcome. Let's dive into the specifics to see how this deal plays out on the ground. Let's talk about DDGS, Distillers Dried Grains with Solubles, a protein-rich animal feed from U.S. corn ethanol. Under the Pact, India will allow DDGS imports, a big win for India's $30 billion poultry industry, where feed is the largest cost. Cheaper DDGS means lower costs for poultry farmers, potentially stabilizing chicken and egg prices for consumers. But there's a flip side. Indian oilseed farmers, especially those growing soybeans, face new competition. DDGS competes directly with Indian soya meal, threatening to lower demand and prices for local oilseeds. This could undermine India's push for self-reliance in oilseeds, making domestic farming less profitable. If oilseed prices drop, farmers may switch crops, complicating government efforts to boost local edible oil production. The Pact's benefits for poultry come at a real cost to oilseed growers. It's a classic trade-off: helping one sector can hurt another. The government must now balance these competing interests to avoid long-term harm. This is the ripple effect of targeted trade deals. Soy oil, a staple in Indian kitchens, is another flashpoint. The Pact allows duty-free U.S. soy oil imports, but only up to a set quota, using a tariff rate quota (TRQ) system. This quota limits how much cheap soy oil can enter before higher tariffs kick in, protecting local farmers and processors from being overwhelmed. The TRQ is a safety net, letting in enough imports to meet demand and keep prices stable, but not enough to crush domestic producers. The real impact depends on where the quota is set. Too high, and local industries suffer. Too low, and consumers miss out on savings. This careful calibration is at the heart of the Pact. It's a compromise. Some imports for consumer benefit, but with strong protections for Indian agriculture. The details of these quotas will determine who wins and who loses. Trade deals are all about the fine print. For millions of Indian farmers, these numbers are make or break. Cotton is another key piece of the Pact. India is a cotton powerhouse, but its textile industry needs extra long staple, ELS cotton, a premium variety it can't grow enough of. The Pact allows duty-free imports of U.S. ELS cotton, but only under a strict quota. This targets a real need for textile mills, without threatening most Indian cotton farmers, who grow different varieties. By focusing on ELS cotton, the deal boosts India's textile exports and global competitiveness. The quota ensures imports fill the gap, not flood the market. Indian farmers growing standard cotton are shielded from direct competition. For the textile sector, cheaper ELS cotton means better products and more jobs. This is a smart, targeted trade move, helping one industry without hurting another. It's a win for Indian manufacturing and a minimal risk for local farmers. That's how nuanced trade policy can be. Apples are a growing favorite in India, but local production can't keep up with demand. The Pact lowers import duties on U.S. apples, making them more affordable, but with a catch. A minimum import price, MIP, is set. Only apples priced above 80 rupees per kilo get the lower tariff. This prevents a flood of ultra-cheap imports that could devastate Indian apple growers. The MIP keeps U.S. apples in the premium market, protecting local farmers from direct price wars. Indian consumers get more choice, but domestic producers aren't left defenseless. It's a balancing act, opening the market, but with a strong safety net. The real test will be how well the MIP is enforced. For now, the Pact offers new options for consumers and a measure of security for Indian growers. That's the art of compromise in trade. Dry fruits, almonds, walnuts, pistachios, are in high demand in India, but local production is tiny compared to consumption. The Pact lowers duties on U.S. nuts, making them cheaper for Indian consumers. Since India already relies on imports for most dry fruits, the impact on local farmers is minimal. U.S. products will mostly compete with other foreign imports, not with Indian growers. For families, this means more affordable, healthy snacks. For American exporters, it's a bigger market. This is a clear win-win, with little downside for Indian agriculture. Sometimes, trade really is that simple. The Pact isn't just about imports. Indian farmers get new opportunities too. U.S. tariff cuts mean Indian tea, coffee, spices, and rice can enter the American market more competitively. This is a big deal for growers of premium products like Darjeeling tea and basmati rice. Lower duties mean better prices and higher incomes for Indian exporters. The rice sector, in particular, stands to gain from reduced U.S. tariffs on both basmati and non-basmati varieties. For many Indian farmers, this is a chance to reach new customers and boost their livelihoods. The Pact's trade-offs are clear. For every import concession, India secured an export gain. This is how balanced trade deals are built, by opening doors on both sides. For Indian agriculture, it's a step toward global integration. The benefits will depend on how well farmers and exporters seize these new opportunities. Every trade deal creates winners and losers. Here, Indian exporters of tea, coffee, spices, and rice win big with better U.S. access. Poultry farmers benefit from cheaper feed, and textile mills from high-quality cotton. But oilseed farmers face tough competition from imported DDGS, threatening their incomes. Apple growers are protected by a price floor, but must stay vigilant. Urban consumers gain from more choices and lower prices. The Pact's impact is uneven. Some thrive, others struggle. Policymakers must watch these shifts closely. Trade is about balancing interests, not pleasing everyone. The real story is in how these changes play out on the ground. The India-U.S. Trade Pact is a story of careful compromise. It opens new export markets for Indian farmers, especially in tea, coffee, spices, and rice. Poultry and textiles get a boost from cheaper imports. But oilseed farmers face real risks from new competition. Protective measures like quotas and minimum prices are in place, but their effectiveness remains to be seen. For Indian families, the Pact could mean more choices and better prices. For businesses, it's both an opportunity and a challenge. For farmers, it's a double-edged sword. New markets for some, new threats for others. The future will depend on how well these trade-offs are managed. In the end, this pact is about finding balance in a changing global economy.